Hi friends, welcome to Adda 24/7. We are in Probable MCQ series for BFM and today's topic is objective questions on yield curves. Now the importance of yield curves everyone knows because entire banking industry or treasury is based on yield curves. So follow this video completely because this is very important from your module B perspective in BFM. Okay? Yesterday's homework. Which of the following statements is correct regarding the yield curve risk? So which of them is correct? Yield curve risk we wanted. The bank needs to evaluate the movement in the yield curve and the impact of the yield curve on the portfolio and the income. So is the bank needed to evaluate the movement in these yield curves? Yes, it is needed because if the yield curve gets lower, then the price of the bonds increases. Okay, so it's vice versa. So that's why that is important. If the liability is raised through 364 days T-bill and is used to fund an asset of 91 days, it could be a yield curve risk. So it will be definitely. Why? Because here you have raised a liability for 364 days. Okay, and the asset means you have given a loan for 91 days. So this 91 days loan will be repaid in 91 days, right? And the liability which you have raised means you have taken a deposit from somebody for 364 days. If the rate of interest goes in the reverse direction after 91 days, okay, then you are in trouble. So both vice versa is also true. If liability for 91 days and asset for 364 days, then also it is a risk. And this part is also a risk. Okay, so the answer is C, both A and B. Okay, now look at this. These are the yield curves, types of yield curves. You need to remember these yield curves. Okay, one is this normal yield curve. See here, yield curve is always plotted against number one. This is time. Okay, means maturity, and this is R, yield, rate of interest. Okay, it's always plotted against time and rate of interest. So as the time increases, remember a simple logic in your bank also. The FD with 3 months, tell me, 3 months FD has higher rate or 7 years FD has higher rate? Generally we have 5 years only nowadays, isn't it? 7 years is out. So 3 months FD has higher rate or 5 years FD has higher rate? Type in the comment section. 5 years or 3 months? Obviously 5 years, isn't it? 5 years FD will have higher rate of interest than 3 months. Why? Because people expect higher rate of interest when they part for the money for a longer period. So this is known as normal yield curve. Means as the maturity goes on increasing, the rate of interest, expectation of rate of interest goes on increasing. This is a normal yield curve. Okay, this lower one is the inverse yield curve, inverted. Means what? As the maturity goes on increasing, people expect lower rate of interest. This is all expectation. People expect lower rate of interest. When can this happen? This can happen if the country is going, any country, if that country is going into a recession. Okay, so whenever the yield curve becomes inverted, remember we are in the recession or recessionary phase. Third one is this straight line. Okay, straight line means flat. So flat yield curve means either 3 months FD or 10 months FD. The rate is expectation is same for both 3 months also or that 5 years also. The rate expectation is same. So this will happen when people are expecting the economy to grow at a standard phase. Okay, not growing also, it will be constant over here, no growth here. And camel hump means this is the last type of the yield curve. Here initial phases we see huge increase and later it decreases. Okay, so initially it's a boom and later it's a recession. So that's called as camel hump. Okay, so let's start. The feature of interest rate risk are. So what are the features of the interest rate risk? Okay, features of the interest rate risk are: it is an exposure of banks' financial conditions to the adverse movement in the interest rates. It has a direct effect on the net interest margin. It may also affect the market value of the equity and all of these. So see here, answer is simple over here because interest rate risk means what? If the bond rates go up, okay, or the R goes up, then the price of the bond gets down. falls down. Okay, always remember, interest rate will, if they are up, okay, so prices of the bond will come down, prices will be down. Okay, if the interest rates are up, other main part is inflation will be down, inflation, it is down. One more part is GDP will be down, GDP, that will also be down. Okay, so that's why because of one interest rate rising, these three factors go down. Out of this, this is good, right? This is good, this is good, but this is bad. GDP is bad, right? If GDP goes down, then what happens? The country goes into recession. Okay, so that's why all of these is the answers. Now before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study material, live classes, ebook, test, everything. Okay, so immediately join this and download it. Okay, what is the yield curve risk? When two different instruments maturing at different time horizon for pricing of assets and liabilities, they are not there may not be parallel movement in the interest rates of both of the instruments. Non-parallel movement in the yield curve may affect the net interest income. So all of these are the yield curve risks. Two different instruments maturing at different time period for pricing and this assets and liabilities. So if I am having the asset of 364 days and liability of 91 days, so these are two separate instruments. So this will pose a yield curve risk. There may not be a parallel movement. May not be a parallel movement means what? If there is, they both don't move in the same direction at the same pace, then it's called as non-parallel movement. Means what? Suppose if the loan is at let's say at 9% and deposit is at 7%, then what is my NIM? NIM is 2%, right? Net interest margin is 2%. So now what happens if the loan grows by 1%, means it grows to 10, and deposit goes by 2%, so it grows to 9. So NIM will be what? 1. So it will affect my what? Net interest income. Non-parallel movement in the yield curve may affect the net interest income. So answer is D, all of the above, isn't it? When the upward sloping curve will appear, means upward means what? Upward sloping is here. Just now I showed you this is upward. When upward sloping curve appears during the time of expansion, when the recession occurs, during economic transition, when the long-term interest rates are lower than the short-term interest rates. So when will it occur? It will occur in, type fast, normal. This time of expansion means normal, I'll call it normal. Okay, time of expansion means normal. So the answer is what? A, B, C or D? It is. When will this upward sloping curve appear? In the normal circumstances, right? Because in the recession, this is inverted, right? It is like this. And when the economic transition means it is camel hump generally. Okay? Yeah. And when the long-term interest rates are lower, means this is the recession. B and D are same. B and D are same. Okay? Subscribe to Officers Adda 24/7 YouTube channel. You will get marathons. You will get free YouTube series on all the subjects in this channel. So subscribe to it immediately. Click on the bell icon. Okay? Define flat yield curve. Short-term bond interest rates equal to long-term interest rates. Short-term interest rates are greater than the long-term interest rates. B. C is what? Long-term interest rates are greater than the short-term interest rates. And D. Small company stocks provide greater yields than the large company stocks. So what can be the answer for this? Now this D has no relationship with this question. Okay, so D is totally out. So it's either A, B or C. Short-term interest rates are equal to long-term. Flat means what? Flat means this, right? Just now I showed you straight line. So flat means what? 3 months FD is also having the same rate and 10 years FD is also having the same rate. So answer is A, correct? How would you define economic transitioning? Transitioning means economy going from either recession to prosperity or prosperity to recession. anything. Okay, so how will you define it? Transition in an economy from recession to expansion. Transition in an economy from expansion to recession. None of the two answers are correct, and D is both answers are correct. So how do I define this economic transition? Is it this only recession to expansion or this? Just now it gave you, right? The answer is D, both of them. Either recession to expansion or expansion to recession. Both of them are true. A yield curve that shows a downward sloping curve is what type of yield curve? Which shows a downward sloping curve. Downward means just now we saw, right? Normal, flat, inverted, or all yield curves show downward sloped curve. All yield curves, all do not show, right? Normal yield curve will not show. Just now we saw this, right? So the answer is what? Yield curve that shows downward sloping curve is what type of yield curve? It is inverted, recessionary. This is the recession. Whenever you see inverted, remember you are in a recession. Okay. A yield curve that shows upward direction and which the longer maturity have higher yield. So that is what? Normal, flat, inverted, or all. Upward. See this. Upward and longer maturity bonds have higher yields. So that is the normal yield curve, isn't it? Normal. Now one for your homework. Now why homework? I'll solve it now only because you are having the exam now. When will you give the homework, right? Which of the following statement is correct regarding yield curve? When the interest rates are floating, banks may price assets and liabilities on different instruments such as treasury bills, call money rates, MIBOR, etc. So when the interest rates are floating rates, okay, floating means what? Interest rates are moving, fluctuating heavily. So in that case, what happens? Bank always tries to build their rates based on what? It always try to build their rates based on the floating rates, means some benchmarks, treasury, T-bills, MIBOR, anything. A bank needs to evaluate, so A is true, okay. A bank needs to evaluate the movement in the yield curve and impact of the curve on the portfolio and the income. So that's but obvious. Evaluate the movement in the yield curve means if the yield curve is going against, then the NIM reduces. And NIM reduces means overall your profit reduces, right? So B is also true. If the liability is raised through 91 days T-bills and used to fund an asset of 364 days, it will lead to a yield curve raise. So that is also true. Just now I gave you in yesterday's homework, right? So that is also true. So the answer is all of these. Okay. So now everyone see these batches. Okay. You can join either the video courses batch or these two batches. See this bilingual for BRBL as well as ABFM. We are having the batches. So join them immediately if you have not joined. Even for the electives, all the electives you are having separate courses. Join them immediately. Whichever elective you might have taken, join it immediately. Okay. Use the code PREP80, PREP80. Look at this code. PREP80. Okay. So let me show you how to use this code. Go to Adda 24/7. Okay. I would always suggest you to go to Adda 24/7. In fact, I would suggest you to download the app first in your mobile. Okay. So go to Adda 24/7. Let's go to Adda 24/7. Say this. Okay. Once you go there, click on the front page itself. Click on JIB and CIB. Okay. Click on CIB 23. Now once you click on CIB 23, you will see the batches series. Okay. Revision batch. Then see a revision batch. Now ABM BFM is over. You will be facing with ABFM BRBL. So we have separate batches for them. So separate batches means you can go or you can just click on view all. Okay. Click on view all and you will see all the batches. All BRBL batch. Then ABM is now over. Then HR elective batch. Just now I showed you all the batches. These batches you will find it over here. Use the code PREP80. Let me show you one batch. Let me show you for the central banking. Okay, because central banking is there now. Central banking elective. Look at this. Okay, this central banking elective. Click on this. Use the code PREP80. Let's use the code. Okay. So here PREP80. See here, importantly I'll tell you, we in central banking I have covered the important questions. Okay, there are separate videos on important questions which may come in exam. Look at this. Using Prep 80 you are getting 80% off. 5999 reduces to 1199. Such a huge discount you are getting. So join it immediately. Okay, you can join the central banking course, you can join the BRBL course, you can join the this ABFM course, whichever you want. So join immediately. Okay, chalo, I'll take the leave. Tomorrow I'll be back with another series.